In this video, I want to show you guys how we can look at market structure from a institutional perspective rather than a retail perspective. Okay, so a lot of you guys might have a simple understanding of market structure, but looking at it from an institutional perspective is really where we can get a strong edge in the market. Okay, so number one, I want to talk through ranging markets. Okay, so this is very simple. And this is simply where price is stuck between a upper and lower bound. Okay, so price is simply just ranging, it's chopping around, there is no real directional bias. Okay, so a ranging market, so this is our upper limit and this is our lower limit here, upper bound and lower bound. And we do not want to be trading ranging markets from within our strategy, okay, because we don't know the directional bias, we don't know where price is most likely to move, okay. So more than likely it's just going to chop around, you're going to get caught in the chop, and that's where a lot of retail traders, a lot of new traders, inexperienced traders, they get caught within this range, okay, and this is really not where you want to be as a trader. Okay, so that's ranging markets, very basic. We don't want to be involved in them, okay? But what we do want to be involved in is number two, which is bullish market structure, and which will signify a uptrending market. Okay, so how do we look at this from an institutional perspective? If we've got a high in the market, we then see a pullback, and then we see a strong break to the upside. This to ourselves indicates a break of structure. Okay, so kind of forget what you know from the retail perspective and try understand the concepts that I'm teaching you here. So we can mark this on as a break of structure. Okay, so we have a high in the market, we have a higher low, and then we have a higher high. So this higher high here, this higher high has broke structure to the upside, it's broke above this level, and that indicates a buyer's market. This indicates bullish market structure. Okay, so once we've identified a new higher high in the market, we can then go ahead and mark on our invalidation level. Okay, and this is known as our guarded low. So GL, guarded low. And this is our invalidation level. We do not want to see price come down below here and close below. This would then indicate that the market is then shifting to bearish structure, but I'll get onto that in a minute. So we do not want to see price close below our guarded low. This is our invalidation level. Okay, once we've marked on our guarded low, we can then identify our point of interest, and this is simply where we are looking to get long on the market. Okay, so if we were looking at an actual chart, we would draw this on from the last down candle before the bullish move to the upside. Okay, so this is our point of interest. This zone here, this is our point of interest. And in a bullish market, we only want to be buying from our extreme demand. That's the only place that we want to be buying in a bullish market, our extreme demand. And that is very, very important. Okay? We want to see price come back into our extreme demand. From here, we would want to see our entry schematic of where we would be looking for a long trade. Okay, so if the entry schematic lines up within this extreme demand, then we can look at taking a long trade and looking to ride this trend. Okay, if we break again strongly to the upside, we then have a new break of structure. So we can mark that on here, a new break of structure, BOS. And then we can also mark on our new guarded low. Another very important concept and bit of information to note is once we break structure to the upside again, we then have a new break of structure here, and we then have a new guarded low. So we can mark on our new guarded low invalidation level and our new extreme demand, apologies. So we can mark on our guarded low, and then we can then mark on our new extreme demand. Okay, the last down candle, bearish candle before the strong up move. Similarly, this is very important, as I said. So once we've seen another break to the upside, we need to move our new guarded low and new extreme demand accordingly, because we always want to be entering from the most recent extreme demand. And the reason why is because if you think of it from an institutional perspective, this is the most recent area where the institution stepped into the market in order to push price to the upside there strongly. So that's why we want to be entering here. And also, so imagine this, right? Price comes, so institutions buy here and push price to the upside. Okay? In order for institutions to buy here, they have to sell into this market. Okay, so they sell into this market in order to create the liquidity to buy from this area here. Okay, so once price pushes up, we've broke structure, and then when price comes back, the institutions will decide on whether they want to exit their other short positions that they didn't manage to close here, and that ultimately will result in another bounce, in another trend move to the upside if they decide to close their sell positions that they use to create the liquidity. Okay? So if the entry schematic lines up, we'll look for another long trade and we'll look to ride that to the upside. Okay? So that's bullish market structure number 2. Now let's look at number 3. Number 3 here is bearish market structure. Okay? We want to see a low in price, followed by a lower high, followed by a strong break to the downside, a lower low. We have a break of structure here, which we can mark on, BOS to the downside, BOS. We can then mark on our guarded high. Okay, so we have a guarded high, our invalidation level. We don't want to see price break above this guarded high. Otherwise, we may be flipping back into a bullish market. We can then go ahead and mark on our extreme supply. Okay, so this is our extreme supply. And this is the only place where we are going to be looking to short from. We're not shorting from here. We're not shorting from here. We're shorting from the extreme supply only. Okay? So in terms of a liquidity point of view, imagine this, right? So institutions sold here in order to push price strongly to the downside. So they sold here, but before they could sell, they had to buy strongly into this area. So they bought into this area. They then exited some of these long positions, and then that created the liquidity in order to sell strongly into this market. So what you have to imagine is when price comes back into this area, are the institutions going to exit their further buy positions that they didn't manage to close, and they're going to look to close them at break even around here? So if they decide to close them, we would then see another leg to the downside. Okay, and that's where the entry schematic comes in, and that's what indicates to us whether they're closing their positions that they use to create liquidity in order to create another leg to the downside. Okay, I've tried to make that as simple as possible. I hope that makes sense. Okay, so extreme supply, we come back in, lines up there, and then we see a new lower low to the downside. Okay, if we see a new lower low, as I said, we can move our guarded high down here, and we can mark on our new extreme supply. So that would be here. That's our new extreme supply, and also our break of structure would move here. So break of structure here, then we would be looking only, and so if and only if price comes back to our extreme supply, then we can look for another short setup. So if price comes back in here, we can then look for another short setup if our entry schematic lines up. Okay, so that's market structure from an institutional perspective, it's probably a little bit different to what you guys are used to from a retail point of view. But that's how I see the markets, and I hope that made sense for you guys.